Starting live video. You are live, my friend.
Action.
Action. Get after it.
What's up, guys? Happy Friday. Conversation Corner number 120. 120.
120.
120, yeah. And hey, we kind of wanted to reach out to you guys again in regard to the real estate investment video that we did last week. That was part 1. We're going to do our part 2 about real estate investing right now.
Boom! Right now. Yeah, that's right. I popped in.
So definitely stay with us a little bit if you are interested in real estate investing. We covered a lot of cool stuff last week, and I'll just kind of recap on that. We talked about what real estate investing looks like, some different types of real estate investing, as well how easy it is to get into real estate investing, some of the common myths, and also what it really takes to start getting out there and using that to grow your portfolio and your net worth long term. Today we're going to talk about some other things. We're going to get into leverage and creating a snowball effect. How you can really start to get things moving once you get over that 1 or that 2 property, and I'll let Ryan kind of take it from there.
Yeah. So when we were talking about in part 1, I think I kind of said we were starting to talk about leveraging and snowballing effect and all that stuff, because I think a lot of people, when you bring up real estate investment or investment in general, I mean, I know it's true even with my wife and I, when we're talking about what do we invest in, how much do we invest, like where do we invest, all this stuff, you start looking through your budget and you're like, well, this is great that we want to invest in all these things, but we don't have enough money to like invest in all those things that we want to invest in, right? And so I think it's true, and what I've heard from a lot of people and experienced myself, and I'm sure you've obviously experienced this as well because you do it, is when you're doing that first investment, especially in real estate and buying that first property, you are basically thinking to yourself, how am I going to make this work? Like, what does that look like? But once you get that going, then you realize how easy it is to kind of snowball that into the next investment, and then the next one, the next one. The first one, I think if I would ask 90% of my investors, they would all say like, the first one was the hardest one to do, just because we had to jump in and get our feet wet. And then once we got our feet wet, it was like, oh, this isn't so bad. And now we're actually building equity, and now we can use that equity and leverage that against another investment. We're going to get into that a little bit. So Levi, walk me through, like, okay, I want to invest in a property, and I have Ryan as my realtor because he's awesome and he's like the best one in Omaha. And we're going to look at houses, and we find one that I want to invest in. Okay, walk me through what are my options at this point. And I know it depends on a lot of things. So 1, what does it depend on? And then 2, what are like the most options that are used by people when they're going to get lending options
financing
for real estate property?
Financing options. So again, you'd have to get pre-approved. We talk about that a little bit in the first video. If you're wanting to do a traditional purchase with financing, even if it is an investment property, you can finance an investment property. You don't always have to put 20% down. It's a common myth. You can, of course. But you can put as little as 15% down with an investment property. And as far as the requirements go, we look at credit, debt to income, things like that. The cool thing about investment properties, though, you get to use the projected rent in order to offset the projected mortgage payment. So to give an example, let's say you have a projected rent of about $1,500 a month. Your mortgage payment's going to be only $1,000. Then you have in excess of about $500 left over to kind of offset that payment. So it's not going to hurt you in your DTI as much as you might think in your debt to income ratio. So it makes it easier to qualify. And this is something else that you can really kind of start to snowball once you get properties, especially if they're cash flow positive properties. Each one essentially is going to give you a little bit of income. So it makes it easier and easier to qualify up to a certain point. Did that answer that question? I know you covered a lot of things in your question. So
and I think most people think that, at least a lot of the people my age and a little bit older, they're like, well, I always thought that, you know, you have to go in and pay cash for these things.
Yes.
And it's like,
Yeah.
cash is great because then you don't have to use, but you also, in my experience, and when I've talked to other people that have been doing this for years, listen, if you have the cash, do it, you know, but most people don't have
Right.
$60, $70, $80,000 to throw down on an investment property.
Right.
So if you have the cash, great, do it. But also, when I've talked to these other investors and people that have been doing it 40 plus years, a lot of them say, like, you want to leverage the bank.
Right.
If you leverage the bank, so for example, if you have $75,000, right, and I'm just using these numbers, they don't have to be this high because most people don't, but if you do, you could go and buy 3 investment properties and put 15% down on those with that cash, right? And now you've got 3 properties as opposed to buying 1 with cash.
True.
So you leverage kind of the banks
Yeah.
to allow you to go out and then cash flow more money coming in. So that's how that could maybe work. If you're one of those people that are thinking about, okay, this is the first property I want to do, then yeah, you want to, if you have $15,000 or $20,000 sitting around, that's nice because now you can use that as a 15% down payment, go with a conventional loan, and then basically buy your first investment property and then start that cash flow, right? So in Levi's situation, he mentioned, okay, if you can rent that out for $1,500 and your mortgage payment's $1,000, you're cash flowing monthly $500 on that property. So then the next step is thinking, okay, once I get somebody in there and once that money's coming in, what do I do with it, right? And so is there a rule of thumb, or is there something that you've seen or you do yourself when it comes to, if you're cash flowing $500, is there an equation or is there something you use to, you're not obviously going to take that $500,
No.
put it all in my savings account or my checking account. You're going to put some aside for stuff that comes up on the house that's going to need fixed later, all that kind of stuff. So walk us through.
That's awesome.
Kind of that.
Good point. And when you get into investing, you're looking for the long-term benefit, right?
Yep.
Unless you're trying to do a flip property where you're trying to make quick cash, there's a little bit more risk that's involved in that. A buy and hold, or an investment rental property, a buy and hold is a long-term investment strategy to build wealth not only in your monthly cash flow, but also through the equity of the property long-term. So to kind of chime into what your question was, what I typically do, and there's not really a specific rule, but what I like to do with my properties and what I recommend people do, whatever your positive cash flow is, you want to set up a separate account, obviously, whether you do that through an LLC, you have a business account, or even if you just go to your bank and set up another individual checking account, make sure the money gets deposited in there. All the expenses go through that individual account. Whether if you're covering utilities and that's included in the rent, make sure all that stuff goes into that one account. Make it easy for tax purposes and to look back on expenses and things like that. And every single month, when those funds get deposited and then the mortgage goes out, you'll have everything left over that is the net. Now, what I recommend and what I like to do with my properties is just allow that amount to build and build and build and build. And eventually it builds up a nice cash reserve. And the general rule is that you want to have about 6 months of a cash reserve for each individual property, just as kind of a safety net to deal with occupancy timeframes and things like that, and then vacancy timeframes and things like that. And then if you have to, if the washer breaks down and you got to go get a new washer, you got cash, and you can pull from that account and not stretch yourself too far.
Yep.
So to Ryan's point, I think the most important thing, especially for a new investor, don't change your lifestyle. You got an extra $500 a month coming in. Don't go get that new BMW because now your renter's paying for your BMW payment.
Yes.
That doesn't make sense. Hold on to that money. Get that 6-month reserve, and then at the end of the year, maybe you want to cut yourself a 5%, 10% bonus check out of what remains in that account. Go ahead and do that. But make sure that you have your reserve in there and that you're staying safe with your property for those worst case scenarios.
Yep.
So that's what I like to do.
Yeah. And I think that might be one of the number one things mistakes that a lot of people make is they get excited because they're like, oh, I've got $500 now that I didn't have,
Right.
and they go blow it or they go spend it on something else or buy a new car, like you said, and then what happens is you get a hailstorm that comes through.
Oh,
in Nebraska, right?
Weather,
And your deductible's $1,500, $2,500, whatever.
Yeah, that's a good point.
And now you're like, oh, well, I have $2,500 now that I have to pay the insurance company to fix my roof, and I don't have that money in there. So those are the things that you want to start thinking about as far as, okay, let's get a reserve set aside in there. And like Levi said, 6 months I think is good.
Yep.
And then that gives you enough cash for a lot of the major things that could go wrong with your house that you're going to have money for.
Right.
And then at the end, yes, then you cut yourself a check. If you've got, $10,000 in there, obviously, then you're like, okay, I obviously don't need $10,000.
Right.
You can leave it in there, or you can cut yourself a check and be like, okay, I'm going to take $3,000 out, write me a check, and go use that for whatever. But
just to chime into that real quick, and this is where we're talking about the snowball effect and starting to leverage things.
Yep.
The other thing you could do with some of that money, instead of cutting yourself that bonus check at the end of the year, maybe, is say, okay, hey, look, we do have 10 grand in this account. I had plus my 6 month reserve or whatever.
Yep.
But I also have property B over here that has another 5 grand in it. Maybe I grab the surplus out of each one of those accounts,
good point.
and I use that for down payment on another house, right?
Yep.
And then you're leveraging that money to go get another property, do financing, and then just rinse and repeat.
Okay, so now that we've got to that point, walk me through 10, 15 years down the road on this property, right?
Yeah.
And now I have equity in this property, we hope.
Yeah.
And we have equity in this property. We hear people talk about it a lot, but a line of credit.
Yeah.
So how can I use then a line of credit to go purchase another property without dipping into that money we just discussed?
Yeah, so you could do an asset based line of credit. There are banks that will do them, where you can basically get an individual line of credit. Essentially, it's not fixated to a property. It's just an individual line of credit that you are extended via the bank because of you're leveraging.
Yeah.
Again, I have 4 or 5 properties. They're all 50% loan to value. Plus, I got this amount of money in this account and this amount of money in this account. The bank will be willing to extend you a line of credit. Now, it's going to be individualistic on what that amount is and what you're able to negotiate also. But then you can go and start to pull from this line of credit to use that to purchase properties or for future down payments. The cool thing about why I like lines of credit for, after you get several properties is that you can utilize this over and over and over again. It's a revolving account. So essentially you'd be paying back yourself. Let's say you borrowed $20,000 from your own line of credit. You went and used it to buy maybe a rehab house or even for a down payment for another property. You can pay back that line of credit over time, and essentially you'd be paying back yourself, and you'd get to use it again and again.
Yep.
Yeah. And then over time, of course, if you make good on-time payments, you can increase the line of credit, and it'll grow and grow and grow with the bank, and then eventually start buying homes cash if that's really what you want to do.
Yep.
Utilize the line of credit to purchase properties cash, and then again pay yourself back through your own line of credit.
It's good stuff.
Yeah.
Yeah. So that's kind of the snowball effect that we wanted to kind of discuss tonight and go over today.
It's like 5.
It is almost 5. That's true.
Yeah, it's 4:40.
So that's the kind of stuff that I feel like we get a lot of questions on, and like I flipped 2 houses now. Levi's got investment properties. We're starting to get into investment properties now because we flipped, and now we want to move into long term. So we're dealing with all this stuff. We've dealt with it. We have clients that go through it and deal with it all the time. So if you're in that boat where you're like, hey, I want to at least get educated more on this and find out how I can do it, when I can do it, all that type of stuff. So if that's you, let's sit down, let's grab coffee. We can talk about some of those things. If you need to get in front of like a financial advisor or something like that, that's always good too, because then they can take a look at your whole portfolio.
Yep.
Yeah. So again, we just want to be a resource for you. We feel like this is a pretty hot topic right now with just our industry and what people are doing, and it's the number one thing that people are investing in. So it would be a disservice to you if we didn't talk about it, because it is our industry and it is what we work with all the time. And so, we just wanted to offer up some education, some advice on that.
Yep.
Share our experiences as we go through them. Maybe we'll maybe one of these days we'll just like go over to one of our properties and walk
Show
through like
that's not a bad idea.
you know what we did or
it's not a bad idea.
all that kind of stuff. So that might be an option too someday.
Uh-huh.
So anyways, we want to give that to you guys. With that being said,
Hopefully you found some value in it. Tune in. Let us know if you have any questions in the comments down below. Thank you. We had some watchers. Appreciate it. Jen and Allie for tuning in. Really appreciate that.
boom.
Let us know if you guys have any comments or follow-ups. You can always DM us. And then, like Ryan said, if you want to grab coffee and chit-chat or talk about it a little more, plan for your first or second or third investment property. We're happy to help you with that. As always, happy Friday. Have a great weekend. Oh, we're not going to talk to you guys before the 4th of July.
Oh, that's true.
So happy
4th of July.
Yeah.
Boom.
America.
America. Levi's mom likes America.
Yeah,
so there you go, Mama Walker.
America.
If you
She
watch
doesn't
this.
have Facebook.
Oh, okay. Well, that was a shout out to her.
Yeah.
But we like to say
Yeah.
America.
Yeah.
So
All right, guys.
shout out to my people. Happy
Thanks a
4th.
bunch. I'm mad.
See you guys. Boom.